Delta Airlines has just delivered one of its strongest quarters ever. Record revenue, higher profits, a bigger dividend, and all of it while facing the highest fuel costs in the company's history. Is Delta entering a new era of profitable growth? Let's break it down. Delta kicked off the second quarter with one of the strongest performances in its history. Revenue reached a record $17.7 billion, up 14% from a year ago, driven by strong demand across both business and leisure travel. The airline generated $1.4 billion in pre-tax profit and reported earnings of $1.56 per share, outperforming management's own guidance. Despite facing the highest fuel costs in company history, Delta maintained an operating margin of around 9%, increased its dividend by 15%, and continued strengthening its investment-grade balance sheet. These results highlight the resilience of Delta's premium-focused strategy and its ability to deliver strong financial performance, even in a challenging cost environment. Delta's growth story goes far beyond ticket sales. One of the company's biggest strengths is its diversified business model. Premium travel and loyalty revenue both grew by nearly 20% during the quarter, reflecting strong demand from high-value customers. The partnership with American Express continues to be a major competitive advantage, with management expecting around $9 billion in annual remuneration this year. Cargo revenue also surged by 39%, while Delta TechOps, the airline's maintenance and engineering business, remains on track to generate approximately $1.2 billion in revenue in 2026. By expanding premium services, loyalty programs, cargo, and maintenance operations, Delta is building multiple high-margin revenue streams that make the business more resilient and less dependent on ticket sales alone. While the results were impressive, one major challenge remained: fuel costs. During the second quarter, Delta spent $4.4 billion on fuel, nearly $2 billion more than a year earlier, making it the most expensive fuel quarter in the company's history. Yet despite this massive cost increase, Delta still delivered strong profitability and exceeded its own financial guidance. According to management, disciplined capacity growth, stronger ticket pricing, and sustained travel demand allowed the airline to offset much of the fuel inflation. For investors, this demonstrates an important point. Delta's business model is becoming more resilient, even in a high-cost operating environment. Looking ahead, Delta remains highly confident in its outlook for the rest of 2026. Management reaffirmed its full-year earnings guidance of $6.50 to $7.50 per share, despite the significant increase in fuel costs. The company also expects to generate between $3 and $4 billion in free cash flow this year, reinforcing its strong financial position. For the third quarter, Delta forecasts revenue growth in the mid-teens, an operating margin between 11% and 13%, and continued momentum across both premium and international travel. With disciplined capacity growth, expanding international routes, and ongoing investments in technology and customer experience, management believes Delta is well-positioned to deliver sustainable earnings growth in the years ahead. So, what should investors take away from this quarter? Delta delivered record revenue, exceeded earnings expectations, increased its dividend, and maintained a strong balance sheet despite unprecedented fuel costs. The company is also benefiting from powerful long-term growth drivers, including premium travel, loyalty programs, international expansion, cargo, and its TechOps maintenance business. Of course, risks remain. Fuel prices, economic uncertainty, and changing travel demand could still impact future results. But based on this quarter, Delta has shown that it can adapt, protect profitability, and continue creating value for shareholders. It's a strong reminder of why the company remains one of the leaders in the global airline industry.